Okay, year 12. It's Mr. Sinclair here, and I'm just going to run through everyone's favourite accounting documents, the income statement and the balance sheet. I hope this will be helpful to you and you'll be able to look over it time and again to try and understand better how they fit together. Even though we've done it in class a whole lot, hopefully with the video control you'll be able to see, and we'll build it step by step. First of all, the income statement is on the left. This is just done in a spreadsheet, by the way, because it's much easier to do it like this than in a PowerPoint. An income statement used to be called profit and loss account, but this is the new terminology, and that's for the year ended the 31st of March 2015, and this is for RB's headphones, shop selling headphones. And that's really telling us about the performance of the business. Now, I'm just going to highlight, I've blanked out all the text there. I'm just going to magically make that appear. Okay, let me just run through what all this means. Turnover just means money from sales. No, I'll just delete that. It means money from sales, all right? So sales revenue, essentially. Cost of sales just means the value of the stock. Now, specifically, what is that talking about? Let me just magically make that appear also. Opening stock, that just means the stock that you had, or opening inventory sometimes called, and I'll use the term inventory and stock. I'll use those terms interchangeably. Okay, so sometimes I'll say opening stock, sometimes I'll say opening inventory. They mean the same thing. Opening stock means the stock that he had on day one of the financial year. So the 1st of April 2014, for example, he had, what's my magic number here? I'll just put the numbers in here to clarify what all this means. He had £53,000 worth of stock, so pretty substantial amount of stock in his shop. Then purchases means the stock that he bought in over the course of the entire financial year. So £125,000 worth of headphones bought in over the year. Then we subtract from that any stock that was left at the end of the financial year. So on the 31st of March 2015, he basically did a check around the store to see how much stock he had on the shelves and in the storeroom out the back and whatever, and that was 35,000 quid. So he took that away because he hasn't sold it yet, so he doesn't account for it yet. Okay. So we subtract, if we put in the numbers now, if we subtract then the cost of sales, and again you can analyze these figures in your own time, you can pause the video and whatever and look over. If we subtract the cost of sales from the turnover figure, that then gives us our gross profit. Right. Now, we can't run off and spend that money on nice things, expensive cars and holidays and so on, because we have a lot else to pay for. Okay, other costs that RB has would include things like, well, hopefully you're able to pause the video and say some. I will continue and tell you what they are in case you're in a hurry. Things like rent, mortgage payments, rates, insurance, wages, salaries, maintenance costs, utility bills, so electricity, gas, broadband, telephones, all that kind of stuff. Okay? Those general costs, as well as marketing costs, trying to promote the business, they would come in as expenses. So it just really means the fixed costs or the overheads of the business. And we subtract them from our gross profit. So in this case, it's 88,000 of general running costs of the business. They subtracted from the £107,000 gross profit to give us our net or operating profit of £19,000. Now, if it's a sole trader, we end it there. Okay, so it would just look like this. Okay, just really nice and simple. If we were to say it was RB's Headphones Limited, so if I just make this magically a private limited company, or even a PLC, we'll call it, what's a private limited company in this case? Okay, oh look at this, now we're liable for corporation tax at 20%. Okay, so let's just put that in. We then, once we subtract our tax, our corporation tax bill from our net profit, that will, hang on here, numbers have disappeared. No, not bold. I want it. There we go. That will leave us with just over £15,000. From that, then we decide to pay the shareholders If it's a limited company, we pay them a little slice of the profit there. We give them £5,000, and the rest of the money is reinvested back into the business. So it's £10.2 thousand in this case. Okay. So apologies for changing that midway, but it's just to show you that the accounts are slightly different depending on the format of the business. If it's a sole trader, we only get as far as this net profit figure. If it's a limited company, which is quite common, then we have to do this extra little bit about tax, corporation tax, dividends, and then our retained profits. Okay. Now, we turn our attention, we're 5 minutes in, we're going to turn our attention to the balance sheet now, and hopefully we'll be able to see how the two documents fit together. Now, first and foremost, we have we have three real sections, if you like, okay? And I should probably skip these two for now because that will confuse everybody if I leave those in. So let's just get rid of those. So we have assets, liabilities, and owner's funds to deal with. Owner's funds, also sometimes known as equity, if it's a limited company, and we'll come back to that in due course, right? So what are assets, liabilities, and owner's funds? Well, assets are things that the business owns, and we'll look at examples of those in a minute. Liabilities are items that the business owes. So who do you owe money to? Short-term, long-term debts. Owner's funds is just indicating how the business was started, where the money came from, and who has a claim on the business if it was shut down or sold and all the other debts were paid off. Okay. So it's slightly different to liabilities, but we'll see that in due course. So again, I'll highlight this column and that'll make my life a wee bit easier. We'll be able to see this. So we have non-current assets, which just means fixed assets. We used to call them fixed, and it was kind of easy to understand, but you know, all this terminology got messed about a couple of years back, so we now call them current assets, which then ties in with, I guess, balances with current assets. Now let's see what type of assets and liabilities we have. We've got a long list here, and I'm going to run through them step by step. Maybe we'll deal with, let's deal with our non-current assets first of all. Right, let's say RB owns a shop, right? He owns his premises. Lucky him. It's not that expensive in terms of premises. £200,000. That's pretty modest premises by today's standards, but let's just play along. Let's not query the figures too much because frankly, I may or may not have made them up off the top of my head. So £200,000, he's got machinery. Now that could be fixtures, fittings, shelves, it could be computers that he owns, it could be the cash register, it could be a packaging machine he has, I don't know, lots of different stuff. But that kind of tools of the trade, whatever those happen to be in a headphone shop, I'm not 100% sure. But we also then maybe owns like a busted up van or some kind of cheap company car, which is valued right now at £8,000. So if we add up all those non-current, or what we used to call fixed assets, those assets that the business intends to keep for more than 12 months, they come to a grand total, as we can see here, of £223,000. Okay. He also owns other stuff, which is either cash or gonna be cash, we hope, within the next 12 months. And these things are called current assets. Okay, so he's got his stock or his inventory. He's got money which he is owed by customers. That could be corporate customers who haven't paid him yet. So they bought stuff on credit. They signed an invoice and said, we promise to pay in 30 days. So that money is due to him, but he hasn't collected it yet. And then he's got cash. So essentially the running order is this. We have stock. We find a buyer for the stock, and we sell it either for cash, hooray, or we have an intermediary period here where we sell it possibly on credit, hoping to collect that money later on. And that's pretty standard in business. If you sell one business to another, credit terms are absolutely standard, although it may seem alien to a year 12 business studies student. Okay, because you can't get credit terms because you're under 18. Anyway, so that leaves us with current assets. If we add all those up, the stock that he has, the money that he's due from his customers who haven't paid up yet, plus any cash that he has in the bank and maybe on site, comes to 50,000 quid of current assets, right? So this is all the stuff that he owns. So he owns about £273,000 worth of stuff, of assets, of items of value to the business. But it's not as simple as that. He can't just run off with 270,000 quid. because the money's tied up in the business. And he's got bills to pay. Let's find out what kind of bills. Well, he's got short-term bills, that is, debts which are due to be paid in full within the next 12 months. And these things are called an overdraft, which is just, as you know, a form of a flexible loan. He's also got trade payables, so he owes his suppliers some money. Okay, so that could be, it could be money owed to electricity company, it could be money owed to his broadband supplier, if he has broadband on his premises. Everyone has that these days. But mostly suppliers and any short-term bills he has, any short-term debts. His overdraft is just a flexible loan that he needs month to month, just in case he has a cash shortfall. Maybe if his trade customers haven't paid him yet, he has to chase them up. Okay, so about £5,000 in short-term debt, which is not that worrying when we look at this current asset figure, and we'll come back to that in due course. Okay. In terms of non-current liabilities, that just means long-term liabilities, long-term debts, and by long-term we mean more than 12 months. Okay, so that he's got 30 grand outstanding on loans, which, to be honest, if that was a mortgage or something secured against premises that are worth 200,000, that's not a big worry. Okay, so he's not that heavily indebted. I'm just sort of noticing here, looking at it, but we can analyze that in more detail later on. Okay, let's skip on down then, and let's have a look at where the money all came from and who's got a claim on the business other than these guys. So well, these guys have got a claim on the business because this is the bank. They will have a claim on the business if he does not repay the overdraft when requested. Then they will certainly be looking to get that money from him. His suppliers, if he doesn't pay them, there may be legal action taken against him to get that money back. And certainly, again, the bank. Here's the bank, 2 times are mentioned. If that loan was secured on the property, or the property, as we might say, was used as collateral against that money that was borrowed, then they would certainly have a claim on the premises if he chose not to pay. Okay, so they've got a claim. These guys, the bank and the suppliers, the electricity company, they've got a claim on his assets. But also, he has got a claim on all these business assets. Okay. As we'll see here. He originally, owner's capital just means money that went in at the start. Now sometimes that's called equity, so I'm just going to do /equity, because if it's a limited company, it would be called that. It just means share capital, right? So if it was a limited company, we'd call owner's capital share capital, because shareholders are owners. So, I mean, it's potato. We don't need to worry too much about it. So the owner's capital is £103,000. Now look at this magic figure. Net profit. Add net profit. What on earth does that mean? Well, look. Remember our retained profits over here? Okay. That means retained, kept in the business. So that is going to be reinvested into the business. What sort of things could it be used for? Well, any of this stuff. Okay. It could be retained. Oh, sorry. Let me embolden that. He could invest in extending his premises. He could buy more machinery, fixtures, or fittings. He could update his van. It might be a bit rubbish if it's only worth 8,000 quid. He could invest in stock. Maybe that's the most obvious way to reinvest these retained profits. Okay. But it basically, the money is going back into the business in some sort of asset. Okay. So that's essentially a recognition that he originally put this money in, but the business has been successful over a number of years, and he's retained actually quite a substantial amount of money. The increase in the value of the business has gone up by 160,000 quid over the years because he has kept reinvesting in the business, and that's recognizing his extra claim on the business because of his efforts and because of his success. Drawings is a figure that you take away from there, because that just essentially recognizes that he took some money out. Okay, we're almost done, so please bear with me. Okay, now last bit is just to say, right, it's a balance sheet. Why? Our net assets are non-current and current assets added together, and then we subtract from that our liabilities, our short-term and our long-term liabilities, and that ends up with a very healthy figure of 238,000 quid. Okay. That then balances out with the owner's claim on the business. So basically, everything he owns minus the debts that he has should balance with his claim on the business. Okay, so that's the idea of the balance sheet. It balances because the assets, once you've paid any